Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
We do think that there is a potential for EV demand to go down without the consumer tax credit or some of the other aspects of IRA. But remember, we started on our EV journey before we even knew IRA was going to be put in, is going to be legislated. So we're going to continue on our journey to continue to take costs down, provide great electric vehicles as well as great ICE vehicles, but great electric vehicles that customers want to have.
I think in the short term, maybe we could see some short-term consolidation. But over the medium term, there's actually a lot of things within the DeepSeek paper that actually implies that compute intensity and GPU intensity could go up, whether it's things like reinforcement learning or models that train other models, or that synthetic data works. So I think it still remains to be seen.
We're at a really dynamic moment with the Trump team coming in, taking the reins, and beginning to pursue their very bold agenda. And they're being consistent in the sense that we have seen some dramatic executive orders out of the Trump administration. For instance, the federal hiring freeze, the stop work order on foreign aid. But these don't affect national defense. The defense portfolio remains so far untouched. So I think we're going to see very aggressive action in the coming days and weeks from the Trump team.
We got 1 hour to go until the market close, and let's take a look at the major averages here. Obviously, a big sell, particularly in tech yesterday on the rise of DeepSeek, that Chinese AI model that kind of spooked a lot of the AI-related names here in the U.S. Today, the Nasdaq's coming back. It's not recouping all of its losses yesterday, but it is up by 2%. The S&P 500 up 0.9%, and the Dow, which was up yesterday, is up again today, 134 points or so, about 1/3%.
We are bouncing back here. We are in the green. I still think, with DeepSeek, Julie, you still have this sense that investors are trying to figure out ripple effects and implications there. Because if that Chinese company really did what they say they did, and you did build this open source LLM really quickly, and it's efficient, and it's cheap, you are still, as an investor, trying to figure out, what does that mean for OpenAI and the broader LLM market? What does it mean for big tech and CapEx spending plans? We're going to hear from big tech shortly.
Yes.
Even geopolitically, what does it mean for kind of the great U.S.-China AI arms race?
So many questions. Yeah. And a lot of the folks we spoke with yesterday said this is an overreaction. The selling we were seeing yesterday, they said there still is a place for these different kinds of models. But as you say, it's still a question. It's not a settled thing. I will note, when you look at the groups that are on the move today, tech, communication services, consumer discretionary are in the green, still being sold off quite sharply, the utilities sector, which is really interesting. There are a few names there that have rebounded into the green, but as a group, it is still lower because there was this huge run-up in those names on the outlook for increased energy demand tied to data centers here in the U.S. And so was yesterday an excuse, and today, an excuse to take some of that froth out, what people saw as maybe an overextension there. Maybe we're going to talk to an analyst about that later in the show, but that's been one of those sort of hand-in-hand trades.
It's a great question, because now you're thinking, well, will energy demand be as strong as we thought? And those names, to your point, Constellation, Vistra, Giovanna, they all hit record highs just last week. I mean, it's been a run.
It has. And
by the way, the Fed's on deck too. Did you know that?
I forgot about that.
That's going on. That's going on as well. It's a quiet week, Julie. There's not much. For more on the latest market moves, let's welcome in now Margie Patel, Allspring Global Investments Senior Portfolio Manager and Head of Capital Allocation. Margie, it is great to have you on the show. I know, Margie, we were just talking about DeepSeek there. I want to bring you in on that conversation because I know, Margie, you're a fan of the Mag 7, of tech. But when you see DeepSeek, you hear at least what the claims are about this new LLM. Did that make you reconsider some of your bullishness there?
Well, I expected really that this would be a year of deceleration in growth. So in a sense, it's really taking into effect that something might happen to all of this. I think right now there's still a lot of uncertainty about what the effect will be. But I think basically, if you look at previous cycles, when you have a new entrant in that brings out a product, even if it's inferior at a much lower price, demand for all tech increases, and so everybody really benefits. So I'm not sure it'll be a real negative, particularly because many of the tech names have diversified end markets, not just the AI. So we're still pretty positive on the sector.
Margie, that's really interesting that even if something's seen as a competitor, that it eventually potentially ends up benefiting all. You know, I would note, of course, we're also going to earnings for many of these companies, and there has been a lot of talk about valuations as of late. Are we going to see these companies justify those valuations with the numbers we're about to get?
Well, we've had a little, over the last few months, erosion in the price-earnings ratio that's reflecting that nervousness even before we had the DeepSeek event happen, where people are thinking that we may see growth slow down or we may see capital expenditures really impact earnings in a negative way. I think this week is important because we'll hear from three big names, Meta, Microsoft, and Apple. So it'll be very interesting to see what they say about DeepSeek and how they see that market evolving. But we think that tech should still have probably a 20% earnings growth this year, which is really quite high and higher than all the other sectors. And so I think that will really justify their relatively high price earnings ratio. They simply have faster earnings growth than any other sector out there.
Do you think when we do hear from big tech, they tell us, listen, you know, they'll acknowledge DeepSeek, but they'll tell investors, hey, CapEx spending plans remain in place. We plan to keep spending. That's the plan.
Well, that's what they've said, and that's what they've done. And that's, I think investors they like to see that they see an opportunity to invest and get a big return. And yet on the other hand, people have really said, are they being disciplined enough in their CapEx? So it'll be very interesting to hear from the horse's mouth this week what they actually say about that.
Margie, it's not just about tech, right? People are looking for a broadening this year. And really, one of the engines over the past couple of years has been this expansion of PEs, of price to earnings ratios. And we just came out with our Yahoo Finance chart book, which is a long list of charts to help people get set up for this year. One of them from Keith Lernover at Truist looked at the rising forward price to earnings ratio of the S&P 500 versus the S&P 500 itself. And he says, really, corporate America has got to deliver this year for the S&P 500 to keep moving higher. Do you think, I mean, beyond big tech, including and beyond big tech, are they going to deliver?
Yes, I think it's going to be a surprisingly good year, still modest returns. Last year, we did get a big boost from price earnings ratios going up. I think this year, returns will really be more just from profit growth. And the issue is that many sectors of the market really have possibly earnings declines or very modest growth. If we have, say, a GDP that's 2.5%, S&P revenue is up 4%. I think that says we should conservatively have profit growth of 10%. But again, technology may have 20%, and some of the more slow-growing sectors may have profit growth of, 4, 5, 6%. So when you put it all together, though, I still think it says Standard & Poor's should be up conservatively, say 10%, and we could have surprises in revenue growth this year because of some of the changes that the new administration is putting forward that should affect the economy in a positive way.
10%, that's solid, Margie. I mean, what would be your concerns as we head into 2025? What's on your wall of worry?
Well, I think actually, I hate to say not much, but I don't see much out there because the Fed is going to be stable. Possibly they may not cut rates. There's some talk they may raise rates, but still basically even keel from the Fed. And when you look at the economy, there's really no sector that you can say is in deep trouble and likely to pull the whole economy down the way we've had in previous economic cycles. Companies coming into this whole tightening period by the Fed had much better balance sheets. They were much better able to insulate themselves from that huge rise in short-term rates. And so we never had that recession that people were thinking we'd have. And also as a result, we still have a lot of cash on the sidelines that were waiting for that recession, saying, well, if the short rates are 4%, 5%, I don't really need to be in the equity market. I'll be on the sidelines. So I think there's a lot of money that would like to come into the market with the big if there was a big downturn. And I think that's going to put a floor on how much of a correction it will see. So I think if this year, even if we're up 8, 10, 12%, that's still better than money market. It's still better than the fixed income market. And I think that's reasonable after 2 years of plus 20% total return in the Standard & Poor's.
Margie, speaking of fixed income, I just quickly want to ask you about the 10-year, right? For a while there, as it was creeping up towards 5%, that was presenting a real obstacle to markets. Is that threat gone? Or is the specter of 5% gone now?
Well, I think we're really in a trading range on the 10-year. I'd say a wide trading range of 3.5% to 5%, maybe 4 to 4.75%, with short rates more or less where they are, inflation where it is, which is really not a negative rate for the market. If inflation is, say, 2.5% or 3%, a 10-year at say 4.5% is really not very tight. And you can tell by frankly, the market froth, by the ballooning in asset prices in housing, in fine art, in precious metals, things like that. That says to me that the market has a lot of liquidity, and that underlying the statistics that we still have more inflation than the Fed would like. But again, the Fed is very sensitive to hurting the economy, so I don't think we'll see anything bad. So as a result, there's really nothing in the way of an economic expansion for this year. And if profits are able to hold their value, because for years now, companies have been able to maintain those record high profit margins, even though people have been thinking, oh, this year they won't be able to do it. They seem to still have that flexible operating model that enables them to have keep that high margin. So it's hard to be very negative, I think, for this year.
Margie, thanks so much. Really appreciate your time.
Thank you.
We're just getting started here on Market Domination. Coming up, the arrival of China's DeepSeek AI model is affecting almost every corner of the U.S. tech sector, and some for the better. We're going to check in on the software sector on the other side. Plus, we've got a few travel companies heading in different directions. The latest from JetBlue and Royal Caribbean later in the hour. And after the closing bell today, it's the latest earnings results from Starbucks. We'll get to those numbers and analyst reaction in the 4 p.m. hour. Stick around, much more Market Domination still to come. A Yahoo Finance exclusive, the Container Store is back from bankruptcy. Yahoo Finance's Brooke De Palma has the story. It was a blink and you missed it bankruptcy, Brooke. This was a very quick exit.
Yeah, quick exit. They filed for bankruptcy in mid-December, on December 22nd, and now we're already hearing that they have reemerged out of bankruptcy after hitting key objectives that they went into last month, really going after, and that's refinancing its short-term debt, reducing previous long-term debt obligations, as well as gaining access to that key $40 million in new money financing. Now, it is worth noting that throughout the past month, despite much buzz and sadness among consumers hearing about this bankruptcy, they were able to operate as usual across stores, online, and for those in-home closet reorganization services. They also were able to meet their obligations to vendors, employees, as well as customers. No employees were let go during this time, sources told Yahoo Finance, and 2 stores did close since that bankruptcy filing in mid-December, but sources say that that did not have to do with this bankruptcy process. Now, the CEO of the company really optimistic, calling this a new chapter for their journey as a healthier company, well-positioned to drive strategic growth initiatives forward. It's important to note here that the company was unprofitable for the past 2 fiscal quarters. They did tally losses of up to $10 million for the last fiscal quarter, but now they are a private company and they will be moving forward in this bold new chapter, I guess, as you would call it.
New chapter. So this is part of this kind of broader trend, Brooke, right, of companies trying to make comebacks from bankruptcies. Like who else could be on this list? Who else could have a new chapter?
Yeah, well, 2024 was one of the biggest years of bankruptcy filings. And Joann, the craft store, similar style there, home goods store, filed its second bankruptcy in less than 2 years. Recently, others that have sort of looked to make a comeback include The Body Shop. We also have Franchise Group, that's the company behind Pet Supplies Plus and The Vitamin Shop. All of these really looking to not only come back, but get out in front of the consumer when we're in this environment where it seems like Amazon, Target, Walmart, they're all hitting consumers with their convenience push, with having everything. And so really these niche companies trying to get consumers back in the door and say, hey, you got to come to us in order to get containers, get organization, and all these solutions.
All right. Thank you, Brooke. Appreciate it. Now time for some of today's trending tickers, sponsored by Tasty Trade. First up, a look at JetBlue, as those shares, they are sinking after the company provides a weak outlook. JetBlue, I mean, sinking that's one way to put it. We're down 26% right now in today's trade. Really, this came down to the outlook for Q1 revenue per available seat mile. That was clearly seen as underwhelming. Team at Citi, which has a neutral on this one, does say, given that outlook, they saw limited, makes sustainable free cash flow generation seem elusive for this carrier. So they're on the sidelines. In fact, it looks like, Julie, just most analysts are, in fact, like Citi. They're on the sidelines with this one.
Yeah, JetBlue has had a tough year, of course, right? It tried to buy Spirit Airlines. That didn't work. It tried to have a joint venture with American. That did not work either. So there seem to be 2 issues here. It's the revenue per available seat mile, and it's the costs also. Unit costs this year are going to rise as much as 7%, excluding fuel. And I think that investors are really having a trouble with this because it is in such sharp contrast to what we've been hearing from many of the other airlines. And so perhaps that's part of the reason
signal
why
very
we're seeing
strong
this.
demand.
Exactly.
Right, solid outlooks.
Exactly. So not seeing that in this case. Turning to the luxury market, LVMH topping estimates in its fourth quarter for revenue growth, seeing a rise of 1% versus the expected decline of nearly 2%. However, the owner of brands, including Louis Vuitton, seeing sales of fashion and leather goods declining in the fourth quarter, though falling less than expected. The shares actually was showing the shares in the French trading there, so we wouldn't necessarily see a reaction to these numbers as of yet. We'll have to wait for the regular session in Paris tomorrow. So the numbers kind of meh, I guess, when you look across here. And the CEO, Bernard Arnault, saying the environment last year was more delicate and that this year has started relatively well.
Yeah, interesting what folks are buying in this market. So fashion and leather goods sales, they declined 1%. In the fourth quarter. Overall revenue looks like up just about 1%, but sales of watches and jewelry, those actually did rise.
Yeah,
So people are finding things to buy still, Julie.
I guess they are. And then also the Bank of America Institute coincidentally just put out some data on luxury, the luxury market that was quite interesting. They talked about for 10 straight quarters, we have seen year-over-year decline in luxury spending. Bank of America uses their credit and debit card data to try and get to the bottom of that, but they said things are finally starting to improve. So that's thing one. Thing two, Americans are actually spending on luxury when they travel abroad, which was kind of interesting. And number three, luxury services, kind of related to point number two, luxury services are more popular than goods. Luxury trips, things like that. So, maybe a little bit of light at the end of the tunnel. You see there the rate of decline has been improving, but still in the negative direction. We'll see what happens in the first quarter.
All right, shares of Cisco, let's take a look at that one as well. That is under pressure despite the company narrowly beating estimates, reiterating its full-year net sales outlook. Cisco's local case volume within U.S. food service decreasing in the quarter. So this Cisco, so not routers and switches, Julie.
Right.
This is the food and beverage distributor.
Yeah.
U.S. case volumes, it looks like did miss expectations. Company saying it was a choppy quarter for the U.S. food service business. Hurricane impacts they talked about at the beginning of the quarter, holiday shifts that negatively impact the end of the quarter. Team at BMO, and they like this name, but they did say quality of the EPS beat and reaffirmed guidance in question, given that they were aided by sales leasebacks and higher buyback expectations. Stock has not done much over the past 12 months. In fact, it's actually edging in the red here, but still plenty of fans on the street we should point out.
Yeah, the case volume there was up by 1.4%, but that was below what a lot of analysts were looking for, and local case volume fell by 0.9%. And one analyst over at Wells Fargo pointing out that some of the boost actually came from M&A, so if you exclude that, the numbers looked even worse. And then there's a company that is now called XPLR Infrastructure that was until recently called NextEra Energy Partners. The shares nosediving as the company suspends its dividend. Now, as I mentioned, it recently renamed itself just in the last week or so to XPLR. And the company now suspending its dividend. It says it is shifting its business model here, that it's not going to offer a dividend for an indefinite period. So effectively, for the foreseeable future, it is connected with, or was connected with, NextEra, the utility company and power generation company. So interesting to see this sharp move downward here. This
is I'm just looking. This is talking about. This is the most we've seen a drop. This is in 2020. I mean, this goes back a ways in terms of the size of the drop. But it does seem like, listen, it's suspending the distribution to shareholders for an indefinite period, right? That's not going to go over well. So, also J.P. Morgan saying, yes, they're suspending the dividend indefinitely. They said that aligned with expectations, though significantly lower, they point out, than consensus expectations, which were looking for just about a 34% cut. So maybe it's a surprise there, and you see it in the trade.
Yeah, 100% cut is bigger than 34%.
Sure is.
Well, the arrival of China's DeepSeek AI model has rattled every corner of the U.S. tech sector, and that includes software, but could it wind up being a good thing? Joining us now is Brent Thill, Jefferies senior analyst. And Brent, it didn't even rattle it uniformly, right? Like Salesforce was up yesterday. I think, people are still trying to figure out what to make of DeepSeek. They're going to be trying to figure out what to make of DeepSeek. What effect do you think it's going to have in particular on the software industry?
It's really positive for software. We've said that effectively as AI costs drop on infrastructure, it helps democratize and brings it to the software layer. So we've seen the last 2 years, I've said this repeatedly, and in technology, you didn't want to be a software analyst, you want to be a hardware, semi, and networking analyst. It was AI infrastructure. You don't have artwork without walls. You can't have AI apps without infrastructure, right? So we're building all this infrastructure to then hang all the AI apps on top. And so what's happening now is we're getting proof that we're getting more efficient. We're effectively adding new capabilities to software, and that's going to help bring more opportunities to monetize in the software layer. We haven't seen it yet. Less than 5 to 10% of AI deployments in software are live. It means 90% are sitting in a lab with Homer Simpson in a lab coat, right? And as those go live and they get used, that you're going to get more use cases, and then you're going to have more monetization. So we think this is very good for software if this is true. Now, no one believes it's fully true, right? We can go into the details of that. But ultimately, it's great to see the technology evolve. It's great to see a new competitor. It's great to see what's happening for the industry. We knew there'd be a moment where there'd be a shift from infrastructure to software. And I think the market sold off so violently yesterday in infrastructure. I mean, there were stocks that were down 30%. It was because everyone had rotated so hard in their investment thesis on AI in just all infrastructure. And we've said this repeatedly, everyone is underweight software. They need to have a position. They need to own the group. And you look at the IGV, which is the software index today, it's up over 3%. And the SMH and the semi side's only up 1.9%. So you're seeing the rotation happen. It's one of the biggest unwinds from semis and infrastructure to software that we've seen in the last 2 decades. So there's a big shift in institutional money that's flowing that way, and we think it makes sense. Again, it's going to be slow for software. It's not going to happen overnight, but we believe this is a very positive beginning of an event. And again, I think there's a lot to verify how much of this is true. Is this, why did these claims come out 1 week after Trump unveiled the AI bill? Everything seems a little, strange in terms of the timing. And again, I'm just shocked that one company could rattle the industry this much. You look at what happened in OpenAI when they launched ChatGPT. Google went to $90, and it's now a $195 stock. So the lesson is, anytime one company rattles the industry and says it's never going to have that big of an impact, and so we just think it is a great buying opportunity for tech, given the dynamics. We've seen this movie before. And again, it was very reminiscent of what happened at Google. And not one company's going to take down all of tech. It's just not going to happen.
Brent, when you say that nobody believes all of this is true, what parts of the DeepSeek story do you kind of raise an eyebrow at? Do you think, I'm a little skeptical?
Well, I think there's a couple of things. One is, when they say they're that much more efficient, okay, they're saying that they are. It's like you and I running a track meet, and I know you're a way better runner than I am, okay? But I'm faster than you. Okay, well, what's the proof, right? Did this get audited by a third party? Did they run these side by side? There's chatter that there's all kinds of chatter, right? That this isn't fully true. Second, you have to ask yourself, where did it come from? Right? Came from China. Third, again, I think there's credibility to this technology. Everyone from the CEO of Databricks to Mark Andreessen, everyone's saying, hey, the technology is there and it works. I think ultimately, at the end of the day, it's a consumer app. Are the largest banks and insurance companies and aviation store companies, name industry, are they going to embrace this technology? Alibaba Cloud never got adopted by U.S. companies, right?
So I guess the question is,
and then Meta just raised their capex by $10 billion.
Well, okay? I guess
They're very smart people. They have a huge investment in Llama, which is open source. Why would they raise their capex by $10 billion if there's really this much efficiency? So I think everyone's kind of going all this stuff doesn't add up, guys. It doesn't add up.
Well, Brent, do you think that there is a possibility of a U.S. version of this? If one of the, so there are two reasons that maybe big U.S. corporations wouldn't go with this. One, it's a Chinese company, and we know there are some geopolitical issues with that, as well as cybersecurity. Two, they don't believe necessarily that it's going to work to the caliber that they needed to work for. But is it sort of a call to U.S. companies that they do need to be trying to work on a lower cost, more efficient model? And to your point, that could be really good for software companies. It might not be as good for some of the other companies that you look at, potentially like the hyperscalers, if they are overspending on this capacity.
Look, we're so early in this race, and it's so early. Okay. How could 5 of the smartest technology companies in the U.S. be that stupid and spend this kind of money if they didn't see an opportunity? They're all working on trying to get costs lower. Microsoft is trying, and they want this to happen. All these companies want this to happen. So the reality is, I think they're all trying to do this. And again, you can't just listen to what they say. We have to see it in the real world, and we have to actually understand what's the bench test. But right now, no one can verify that. So what we're doing is we're basically we're having to believe what they say. And the question is, do you believe what they say? And not many people really believe that claim. Now, the technology works. The technology can be a whole nother thing. And so, yeah, I mean, look, there are 5 productivity apps. You can go to the App Store right now. You can download Perplexity. You can download Google Gemini, which I've been using, which is great. You can download Claude. There are 5 consumer apps that are really good that you can download right now to help your day. But I don't think major enterprises right now are willing to commit. Now, they're divisions and there's signs that this can work in the enterprise. But I think again, is it going to be on-prem or is it going to be feeding all the data back to China? And are you feeling comfortable with that? I think a lot of companies are not going to feel comfortable with that.
On that point, Brent, actually, I was all set. I was going to download and experiment with DeepSeek, and then I had Anthony Pompliano, Brent, on my show yesterday, Mr. Bitcoin himself. I said, "Hey, Pomp, did you do that?" He looked at me like, he said, I don't put Chinese software on my phone. Is that how you're thinking about it, Brent? Or no, did you download and play around with DeepSeek?
I haven't. I was in Japan. I just flew home, so I've been traveling. But the reality is, I already have trusted apps that I use. I use Gemini. I use Perplexity. These are great products. They're very different, and so I'm using them both. And I don't need 5 different productivity apps. So I think the real interest will be, can they cross the bridge to become an enterprise player, and not just only on the consumer side. And we'll keep an eye on that. But I think there's some big barriers to get to that point. I think Julie's point, all the rest of these companies are trying to figure this out, right? They're all working on this. And I'd say that Meta, Apple, Amazon, all these companies are very smart. The other thing is, all these companies are very clear. They want to embrace all the models. They don't care. They'll take all the models. If you want it, great, take it. Amazon's taken a very different approach. So these layers are going to commoditize. It's the applications. It's the things on top that are going to make a big difference. And that's where I think the rest of the industry is going. So you can swap in and out these languages. As Microsoft CEO says, there's a small language they have a large language. They're not going to replicate what OpenAI has done. There are going to be multiple languages that thrive. So I'm not here to say like this isn't going to work. I'm just here. I think there's some big challenges, and I think the market massively overreacted to what is a great enhancement, but it's not. Again, I think there's so many parallels to what happened with ChatGPT and Google, and investors are going to make a lot of money being long tech here, and they're making money today off of this. And I think the overreaction is borderline crazy, the way the market reacted. And I think it tells you how far they over-indexed to AI. And I think a lot of investors don't even know what they own, honestly. So there's a lot to be learned from this. But I just don't think it's as big a deal, and the overreaction I think was excessive. And there's a lot we have to learn still. So there's a lot we can't make a call on yet because we don't have the proof.
We will wait. Borderline crazy. We'll leave it there, Brent. Thank you as always, sir. Great to have you on the show.
Good seeing you. Take care.
Thanks.
Coming up, shares of Royal Caribbean sailing higher today on the back of their latest earnings results. We're speaking to the cruise liner's CFO on the other side about the numbers. Stick around. Much more market domination. That's still to come. Royal Caribbean reporting a beat on earnings, citing stronger pricing on close-in demand and continued strength in onboard revenue. Wall Street also cheering on a better-than-expected profit forecast for 2025, as Royal Caribbean already sees a record start in wave season bookings. The company is setting its sights on a new vacation offering. Royal Caribbean Group CFO Naftali Holtz joins us now to discuss. Naftali, it's always good to see you. So you reported, investors clearly like what they see, Naftali. Your stock is up almost 13% right now in today's trade. Walk us through the business. What drove the quarter?
Yeah, so first, great to be with you. We finished the year on a very high note with very strong fourth quarter results and a great year. And we saw very amazing momentum coming after our last earnings call into this year. Bookings have accelerated. Actually, the 5 best booking weeks in the company's history have occurred since last October. So we're continuing to see the demand for our vacations. Consumers are telling us that they are prioritizing travel and vacation as the #1 priority in their life. And so we're very excited about the demand. You can see that in the bookings. You can see that in our outlook for the year. And our proven formula of adding ships every year, moderately growing our revenue yield, and having strong cost control delivers very strong results. And you can see that we think that this year we're going to deliver 23% earnings per share growth. So we're very excited about 2025. Started on a very strong note on strong demand, and we're very excited about 25 in the future.
Naftali, if you could give us a little more color on the demand and what you're seeing. In other words, you talked about revenue yields going up. Are people spending more money when they're on ship and on trips? And what are you seeing in terms of the pricing tiers of the cabins that are getting booked out? I'm just curious in terms of price sensitivity at all, if you're seeing any evidence of that.
Yeah, so first, the demand is very robust across the board. And people really value the vacations we deliver on our brands and are really, you can see that in the demand and the bookings. And also, they're willing to pay for that. Now, cruise is a very attractive value proposition. So when the consumer is looking at the alternatives, they look at cruise, and the quality of the experience is remarkable. We get amazing guest satisfaction scores, actually higher than any other land-based vacation. And at the same time, in terms of price, it's a very attractive value proposition. So that continues to be very attractive for us. Cruise consideration continues to be high. And it's really demand across the board, across our brands, Royal Caribbean, Celebrity, Silversea, TUI Cruises, as well as our products, Caribbean, Alaska, Europe. So it's a very broad-based demand for our vacation experiences.
Now, talking about this new river cruise business, why launch this product now, Naftali? And how are you all going to sort of separate yourself, distinguish yourself from the competition, from the likes of Viking?
Yeah, so we see a tremendous opportunity to continue to win share in a $2 trillion vacation market. We're a $65 billion category, and we have continued to win share from the consumer. And so over the years, we've done an amazing job delivering the vacation of a lifetime across our brands. And so that you can see that in our results and all the success that we've had with our innovative ships, private destinations, and just the quality of the experience that we deliver. But our goal is actually to deliver a lifetime of vacations and capture more of that customer vacation time and spend into our ecosystem across our brands. And so river cruise is a very attractive market. Our customers actually are telling us they are going on river cruise. So half of our customers are actually either been on a river cruise or intend to take one. And half of them are actually telling us that this will be an incremental trip. And so we want to capture that into our ecosystem and really do that across our brands. And so we're starting with Celebrity River Cruises, which we launched today. We're very excited about that. And we think we can win share. It's a very fragmented market, despite the fact that it's growing and very large. And it will be part of our vacation offerings. And together with our loyalty, match status, and reciprocity across the brands, we think we can deliver not only a great vacation, but also keep the customer kind of within our vacation ecosystem.
Right,
and the time, is great. The balance sheet is back, and we feel that that's a great way to kind of continue to grow the business.
Right, and those will first set sail in 2027. Naftali, as part of that, as we mentioned, you guys are ordering 10 ships over time. You're also adding to the regular fleet, the seafaring fleet. I'm curious, is there any kind of tariff calculus for you all, or are the ships not technically delivered to the United States? I mean, how does that all work, and does that calculate into your costs?
Yeah, so we don't expect that to have any impact on our orders. We do have multiple orders on the ship of ocean ship as well as river, and so obviously when we order the ship, we make sure that we get the ship that we want, to make sure that we deliver on the experiences, and of course we're very much focused on making sure that it's accretive to our earnings and to our financial performance.
Naftali, good to see you. Thanks very much for your time.
Thank you.
The Federal Reserve kicking off its two-day FOMC meeting today. Wall Street largely expecting the central bank to hold interest rates steady tomorrow. Our next guest thinks that 2 to 3 cuts do seem still likely this year, but what needs to happen to make sure that we're going to see them? Joining us now is Ian Wyatt, Director of Economics at Huntington Commercial Bank. As you know, Ian, thank you for being here, especially in person. As you know, not everybody's on the same page with still expecting cuts this year. There are plenty of economists who now said, maybe we won't get any. What do you think is the swing in your case?
I think there's still inflationary pressures in the economy. I think some economists have missed this to some degree, in that there is services inflation. I think the inflation, when you break it down by type, it's really not. Durable goods have been pulling down inflation. Actually, car prices, used and new, down, furniture prices down, but it's generally discretionary consumer purchases. The stuff like childcare, where we're still seeing wage pressure. When I still talk to companies, I'm still hearing it in things like retail, transportation services, those kind of things. And a lot of those are things consumers have to spend on every day. So I think that inflationary pressure is there. But I think we have other things helping on the inflation side. I think car prices are still helping. I think apartments, we have oversupply of multifamily in a lot of markets. We are seeing negative apartment price of rent growth. Now that's about a third of consumers are renters, so that's going to affect them. Then you get into the owner equivalent rent piece, and so I think that's maybe trending 1.5%. So that gets you closer to the inflationary target. I think the Fed's going to pause for a while and wait for the data to come in. I think Powell ends up on the dovish end of the spectrum here. He's sort of out there a little bit. You look back at the data, you can see it in the dot plot. Like September was a very close vote, that 2 versus 1 cut. So I think this is kind of the compromise here for the hawkish folks, is we pause for a while. We wait to see that, but I also think the Fed's very conscious that they are putting the brakes on the economy. And there are segments that are struggling because of that. Such as commercial real estate, for example. Those durable goods segments, autos, have faced some real pressure from car, what it costs to get a car loan. Mortgage rates, existing home sales really feed into those durable goods sales. That's part of the story in warehouses. It is directly correlated with, we have an oversupply of large warehouse space. Why is that? It's partly because people aren't moving, and therefore they're not renovating, they're not swapping out furniture, drapes, flooring, whatever else, all sorts of things that take up a ton of room. Instead, they're traveling on cruise ships. It's been, the last year, if you look at the TSA data, you're up, especially on holiday weekends, we're still up when it's consumer-driven travel, 5-6%. International travel's solid double-digit growth in terms of, people going through, like putting in their I-9s, going through immigration. And so we still see a consumer spending on travel. We see consumers with healthy balance sheets. And I mean, this is a great example. The Royal Caribbean earnings and early bookings really show that a lot of folks are still pretty confident in their balance sheets and feeling pretty good.
Ian, let me ask you about tariffs. I'm curious whether you think those are necessarily inflationary, because Scott Bessent, Trump's pick to run Treasury, he's written that Trump's first-term tariffs did not raise the price of affected goods. I'm just wondering if this time is different, if the economic backdrop is different.
I mean, I think that's always a complicated question, because fundamentally you have so many moving parts. Like, we're talking about potentially 25% tariffs on Mexico. If you look at the Mexican peso since May, it's basically been a 25% depreciation in the exchange rate there. So it can be offset by all their other moving parts, and whether or not that's inflationary really depends on those other moving parts. I do think fundamentally, though, right now in trade, we are set up in a dynamic with just the boom in Chinese exports in almost any category you can think of. Everyone's talking about BYD and autos, but obviously it's technology. We've seen it today. This week, we've seen it even, I was talking to plastics manufacturers, and they were talking about just massive growth in Chinese supplies of basic plastic petchem, the little pellets used to make plastics. And so across the board, we're seeing this wave of Chinese exports, and countries that have domestic industries to protect are being more aggressive in protecting them and raising trade barriers. And I think that's a headwind for US exports everywhere. Really machinery exports, that Chinese competition. But also if you're, say, going to a third party, say, somewhere in Latin America that has no domestic industry to protect, they're not really gonna care if they get the goods from the US or China. They're just gonna take the best value for them. And so when we talk to exporters, this is a real concern. Tariffs specifically, though, I think they're waiting and seeing. They're going to see how it plays out, see what hits. I think that was sort of the Fed's conclusion when some of their research papers says, wait and see. We'll see how it plays out in terms of inflation. We'll react afterwards, and we'll see what the effect is.
Ian, thanks for coming in.
Thank you.
See you again. Coming up, what does China's DeepSeek AI mean for U.S. utility stocks moving forward? They've been selling off. We'll speak to an analyst on the other side. Stick around, much more market domination still to come. China's DeepSeek app ramping up competition in the artificial intelligence space. While the tech sector is making up some of those losses, utilities are struggling to recover and in sort of an uneven fashion. For more, we're bringing in Anthony Crowdell. He is Managing Director and Senior Analyst of Utilities at Mizuho Americas. Anthony, thanks for being here. This is a group that has obviously been soaring in a way that utility investors have not really been accustomed to in the past because of this perceived increase in demand related to AI. The past couple of days, we've seen a lot of that melt away. What do you think is going on here? Where does the true demand picture lie for these companies?
I mean, Julie, you've asked probably the billion-dollar question, right? When utilities typically do well, we do well because of fear and people looking for a safe haven. And this is a new thematic for all of us in utility land where we're excited about load growth, we're excited about the data center story, excited about earnings growth. I guess where does it lie? I mean, I think one of the problems is maybe we were a little over our skis, especially on some of the IPP valuations. I mean, if you look at the Calpine Constellation deal, I think Constellation paid $16 billion for Calpine, and day one, the stock went up $20 billion. I don't know if the stocks were following fundamentals or trading on fundamentals when something like that happens. So I think the DeepSeek information or the DeepSeek story, if I use that, probably took some air out of it. But I mean, Constellation earnings are fine. Utility earnings are fine. We're seeing, strong load growth. We're going into this earnings cycle looking for a continued increase in load growth. But this could put some cold water on the data center build out, and it's clearly going to impact utilities' growth plans.
But Anthony, I'm just curious, when you did read about DeepSeek, heard about DeepSeek, did it cause you to rethink any of your ratings, your recommendations in your coverage universe?
No, so actually the opposite. It made me feel even better. We're neutral rated on Constellation, which I think was the #2 performing stock in the S&P 500 last year. And we just struggled with valuation. Nothing about the business model, good management team. For us, it was just what people were willing to pay for an IPP story. But it didn't matter. Just this is what happens, I think, when I covered this cycle back in 2003, 2004. And this is what happens when tourists invade a value space. And they just push these stocks up to huge valuations. I don't know if it was tied to fundamentals. So hearing that we may have a pause on this, some of the companies putting out high single digit, some people forecasting huge increases in power prices. When I read that story, I said, I actually feel really good about my neutral rating on Constellation. But admittedly, I've been wrong for a year or two because the euphoria just keeps pouring into it. And it'll be interesting to see if it slows the growth down. But valuation-wise, trading at a 60% PE premium to regulated utilities seems there's maybe some froth in that story.
Well, I mean, but by the same token, just to push back a little bit, Anthony, some of the enthusiasm has come from some of the deals that have been signed, right? And I think really the one that put things over the top was the Microsoft 3 Mile Island situation, because there was the promise that these hyperscalers were willing to pay multiples of what regulated electricity rates are. Does DeepSeek throw that into question, or did you think that was not really a sustainable situation even before DeepSeek?
Well, even before DeepSeek, and I just want to correct you on a technicality. You said the word deals, plural. We've seen one deal, singular, and it was on that exact project that you mentioned for a very attractive price. Forward curve of power is at $55, and that price is somewhere $100 to $120. If you add in tax credits for Constellation's like $140. But that's the only deal we've seen for a hyperscaler to one of the IPPs. And we struggle, investors, utility analysts struggle. If I was Meta, if I was Google, if I was Microsoft, and my CapEx cycle included $60 billion in data centers, I would go out there and lock in the electricity. That's what I would do. I mean, it's like you going and getting a summer rental, getting beachfront property, planning this huge vacation, and then saying, I'm not going to buy suntan lotion. I don't have that kind of money. Like that's impossible. So we've only seen one deal, and I could be wrong in a week. We could go through this earnings cycle and now start getting deals printed nonstop, but we have not seen the data that supports what Microsoft did. Now, what Microsoft may have done, and obviously I'm not Microsoft, I love my Microsoft analysts to talk about it, they may have been just more supporting nuclear energy and the bringing back of 3 Mile Island, now the Chris Crane Energy Center, or Crane Energy Center. I think that was maybe more supportive of that versus locking in a PPA at whatever, $120 or $115 versus the forward curve at 55. We're waiting for these deals, but so far I have a comp group of one of that one deal, which I don't follow, given the hyperscalers I think would look to go lock in electricity.
Anthony, let's talk about some stock picks as well. Names you like. Duke Energy, it's up about 16% over the past 12 months. Anthony, why is that one a buy here?
Well, first, I like it. If you think of where they're located, southeastern part of the United States, they're not just a data center play, which is what I went into this with this mindset. When the earlier question, any ratings I was nervous of. No, it was the opposite, where Duke is not just benefiting from that, but also if you look at the onshoring of manufacturing and just the underlying economic growth in some of these lower taxed areas people moving to, Duke is a beneficiary. Duke also has really solid regulation in the Carolinas, Florida, where they operate. And here the name's trading at, a 3% PE premium, when I think it should be high single digit to double digit, 5 to 7% earnings growth with this great backdrop and hopefully a nice catalyst on the earnings call coming up of increase in load growth. I mean, just you guys are located in New York. I'm located in New York. I'm sure you have a lot of friends that are saying, I'm moving to one of the low-cost, better weather areas down the southeastern part of the United States. The only pushback I could get on Duke is people say, well, hey, look at the storms that hit this past summer. A lot of damage occurred. But the regulators, the regulation that they have in those regions have year on year provided great recovery mechanisms to make the utility whole for what they've spent on it. And I think you noticed that in how quickly the areas are restored. So Duke is abiding me 3% PE premium. I think it should be high to a 10% PE premium. Nice balance sheet, Baa2. I think investors are going to look for on the next earnings call, increasing their load growth.
Anthony, really interesting stuff. Thank you so much for joining us. We'll definitely keep in touch as we continue to watch this, what has become a kind of a wild space. Thanks a lot.
You bet.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. There's the closing bell on Wall Street. And now it is Market Domination Overtime, sponsored by Tasty Trade. We are joined by Jared Blickery to get you up to speed on the action from today's trade. Let's take a look at the close here. Quite a different one from yesterday, but not really for the Dow, actually. The Dow up yesterday, up today, about 137 points, about a third of 1%. Not too different from yesterday, but the S&P 500 up 0.9%, rebounding from yesterday's DeepSeek-induced sell-off, and the Nasdaq up 2% on the day, so rebounding as well. Now, to put it in perspective, it did not recoup yesterday's losses. The Nasdaq Composite still down 1.1% over the past 2 days, so just recouped some of the losses. And as Josh and I have been talking about, really yesterday and today, there are still a lot of questions about the veracity of DeepSeek's claims that it did not have access to high-powered chips to power its model, questions about efficiency, questions about what it means for AI models here in the US, questions, as we were just discussing, about what it means for the power industry, utilities, a lot of questions still. And so those questions still equaling a drop in the Nasdaq over the past couple of days, even as we saw the rebound today and a rebound in a lot of the large cap tech names. Jared's got a closer look at all of that.
Thank you, Julie. Lots of questions here. I just want to check in on the S&P 500 equal weight really quickly. Interesting because a lot of times this tracks what the Russell 2000 is doing, but the Russell 2000 is positive. So another divergence there, not making too much of it. So I'll just move on to the bond market where we have a 2 basis point up move in the 10-year. And then you can see over the last 2 days, still tracking some gains there. Also, let's take a look at the US dollar index. That is up as well. And let's just proceed to the sector action. Here we have tech. Tech was the biggest loser yesterday, down 5% almost, and it's up about 2.5% today. That is the biggest 2-day reversal that we've had since November of 2022. So not something that you see very often, but I would remind people that without a couple of stocks, Broadcom and Nvidia yesterday, the S&P 500 would have been positive, so it was very localized. Also seeing communication services and discretionary, those are green, and if you're paying attention here, all of the mega cap sectors that house some of those mega caps, those are green today. The rest is red, so kind of a reversal again from yesterday. Staples is the worst performer of the day. That's down 1.5%. It was leading yesterday along with some of those defensive stocks. Utilities and real estate round out the number 2 and number 3. Let's close here on the Nasdaq 100. What a nice picture that we have with a lot of these names that were just mired in deep, deep red yesterday. Apple, though, is up 2 days in a row. It was up yesterday, it gained about $100 billion in market cap, and it's up another 3.5% today. Broadcom up 2.5%, one of those stocks that got a huge drubbing yesterday, down, 15, 20%. And of course, Nvidia up 8.82%. And if we look at the 2-day, still down almost 10% over these 2 days. Josh?
All right, thank you, Jared. Stocks rebounded on Tuesday following a steep stock sell-off spurred by China's DeepSeek AI and concerns of overconfidence in big tech. For more on the market action, we want to welcome in Nancy Tengler, Laffer Tengler Investments CEO and CIO. Nancy, great to see you on set.
Thanks for having me. It's good to see you both.
So I'll say DeepSeek, let's start there. So bold claims, Nancy. And obviously yesterday you saw investors, they got nervous, they got rattled, right? We saw a spike in volatility, uncertainty, and some names I know you like.
Yeah.
Broadcom,
it's a rough
Nvidia,
day.
They get hit hard. They're both in the green in today's trade. But you as an investor, you see these headlines, you see these claims, you see the reaction in the markets, you think what?
Yeah, well, so Josh, first of all, I think it was traders yesterday. I think investors like me step back and say, fundamentally, has anything changed and do we want to own more? But I think this, that we know that the Chinese government issued a press release in the fall that said they were going to spend $1.4 trillion in stimulus, and some of that was going to AI. Then we hear at Davos from Alexander Wang, who's the CEO of an AI company, that they actually had DeepSeek, that is, actually have 50,000 H100 NVIDIA chips, but they couldn't admit it because they're embargoed, and so then they would have to admit they had them. Those go for 40,000 each on the not black market. So I think, you know, is it feasible that it was a $6 million investment, that it was developed over a couple months? I mean, Silicon Valley knew about this over a month ago. Meta already had war rooms up. So I think the timing was interesting following Project Stargate. I think we need to take it with a grain of salt at this point. I mean, I think the technology is awesome, potentially, but I don't think the costs or the timing of it are accurate. In other words, how little time it took to develop. I think we have to wait. And they crashed yesterday, so there's a capacity issue.
Well, they said it was a malicious attack.
Yes, well, then the security stinks, right? And all the security stocks are up today, too. CrowdStrike and Palo Alto, which we also own.
Yeah.
So I don't know.
So it doesn't fundamentally change any of your theses when it comes to AI, and sort of not just when it comes to AI, but that it's coming, but what it's going to cost to implement it?
Well, I mean, the history of technology is that things get cheaper as we get better at it. So I think that what is going to happen is use cases will explode or expand. So you're not going to see Fortune 500 companies embracing DeepSeek, but you might see retail customers. And there's a whole host of problems with that. If we're worried about TikTok, maybe we should be worried about the security of DeepSeek on our phones. But regardless, there has to be robust security. There has to be robust computing power. Will the spending increase? I think it might, because now we're in an arms race. And so I think this may end up being bullish for the space, but it's a little too soon to tell. But I am skeptical, to say the least.
Skeptical, but as for the broader market, Nancy, if I remember right, you were more generally constructive about what's ahead. How come?
Because we're seeing at the company level, across sectors, we're seeing adaptation of AI. So I think I've been on your air and talked about Walmart as the poster child of a company that's pivoted to all the new technologies, not just AI, not to just digitization, but robotics and cloud computing. And it's improved their margins and their growth. So if you look across, Goldman Sachs is just one of our 5 for 25 and a member of our 12 Best Ideas portfolio. They've come out and said, we can produce about 90% of an IPO offering circular with AI. And then we have analysts jump in. If that's true, that has a profound impact on future earnings growth and margins. American Express is using it for fraud detection. I mean, I could, if I was spontaneous enough, I'd be able to tell you more. I mean, I think, Chipotle uses generative AI. Spotify, one of our 5 for 25, is using it.
Is it really saving them that much money? I mean, given the isn't it expensive for them to use the AI? Or as you said, it's going to get cheaper over time?
I think it's going to get cheaper, and I think a lot of it is being offered as part of a package. So it's maybe not as, it hasn't been monetized as well by Microsoft. Apple was downgraded by a number of firms last week, or a couple of firms anyway, because they weren't in the AI game, and now it's been up 2 days in a row. So I think what you want to do is own great companies with great management teams, because they will figure out how to monetize it, how to pivot, when to spend and when not to spend. And I think we all, like yesterday, I think we all needed to take a breath, and we saw the market do that today. I didn't think it would be up this month. Yeah, it was awful.
Yesterday was big breath.
Yeah.
All right, we're going to put a pin in this because we want to talk about Starbucks earnings. Because they are just out. Yes. I'm going to go straight to the comp sales here. Down 4%, which is better than the 5.3% that was estimated in terms of a drop here. China comparable sales standing out to me as well, down 6%, where a more than 9% drop was estimated. Overall revenue coming in at $9.4 billion versus the $9.3 billion estimated. I do not see, I'm looking for a nice earnings per share number here, but I am not seeing that yet. Are you seeing that yet, Josh?
No, I don't see it popping up just yet.
Okay, so we're going to keep looking for that, but it seems like that there's some relief.
67 cents was expected.
Thank you. Look at Nancy.
It was
chiming in, helping here. Oh, 67 cents.
It's a team effort, Nancy. We appreciate it.
It looks like it was 69 cents was the earnings per share. Okay, which was down 23% year over year, but to your point, better than estimated. Brian Niccol in the statement saying, while we're only 1 quarter into our turnaround, we're moving quickly to act on the Back to Starbucks efforts, and we have seen a positive response, he says.
Yeah, and heading into this print, the stock action was interesting, Julie, because if you pull back the chart, it was only up about 5% over the past 12 months, but it had climbed about 30% in the past 6 months. And obviously, a lot of that is the excitement of Brian Niccol, took the helm here in September, obviously thought of very well in terms of his experience and performance. Chipotle kind of already sort of laid out his vision, at least broadly for investors, talks about refocusing the company as a welcoming coffee house, focused on coffee, better pricing, faster service. So it was a nice run into the print. You're higher here, at least initially in the after hours.
Yeah.
Nancy, and you own Starbucks,
we do.
Right?
Yeah.
So what are you looking for from, first of all, how do you feel about these numbers? And secondly, what are you looking for from Starbucks?
I mean, I don't mean to say I don't care about the numbers, but
You're looking long term.
Yes, and this quarter was kind of the let's throw it all in and he's going to move forward from here. I think what Nichols has demonstrated is that he will be able to streamline the coffee production part of the business. He's already returning them to their roots. I think that's great. I'm personally excited about the condiment bar, as they call it, coming back out. Because it's just so wasteful. Like I take cream a little bit on the side. They pour you about this much, and as a shareholder, I'm like,
Well,
How
and
about
it
a pump?
slows, and it slows throughput, to
Yeah,
your point. It
yeah.
slows it down if they're doing it, not you do.
Yeah.
It's much quicker to hand you a black coffee.
And let me go.
Yes,
Yeah.
exactly.
So I think he's going to make those marginal changes like he did at Chipotle, and we're Chipotle shareholders. So the day when it was announced he moved, I had good news, bad news crisis.
Yeah.
But I think the board finally demonstrated that they understood they had a problem, and there have been a lot of changes in the C-suite. I think that's
Even
good for the
today,
company.
they announced some changes.
Oh, I didn't see that. I've
Yeah, they
been
announced
running
management
around.
changes today.
Yeah.
It sounds like, Nancy, too, it's sort of also rethinking just what Starbucks is and should be,
Yeah.
Getting back to his roots, he called it. How do you think about that as a shareholder? Like, should Starbucks be a place where Josh gets a coffee and then relaxes, listens to some Spotify, or no? Would you rather say, let's make it more of an assembly line? Let's make it efficient. Get the coffee, get them out the door. What is it?
I think
what
he's going to
should
do
be
both.
the culture?
I think he is going to do both.
Yeah.
So think about Chipotlanes. I mean, that drove growth at Chipotle, where you just had a drive-through, but people were still using the restaurant. I think it's important for people to use the restaurant, and I think it's also important for them to expedite and streamline. And so the order ahead has to get better and more efficient. In suburbia, it can be through Chipotlanes. Or Starbucks lanes, and I'm pretty sure he'll be able to figure out how to do it within store, like in a city like Manhattan.
And one more thing, I mean, is Starbucks still a coffee company or is it a milkshake company? Like, I say that a little bit jokingly, but what is it? Something like 60% at least of what they're selling now is cold.
And high calorie
it's
company.
not just exactly.
Yeah.
So I don't know. I don't know about that part of it. But anyway, thank you so much, Nancy, for being here.
Thanks
it's
for
great
having
to
me.
see you.
Coming up, we're going to get you some analyst reaction to the latest earnings results from Starbucks. Stick around, much more market domination over time still to come.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern. Starbucks topping revenue estimates and reporting better than expected comparable sales in the first quarter. As it's one quarter into its turnaround, CEO Brian Niccol highlighting the company is moving quickly to act on what he has called the back to Starbucks efforts. Here with a closer look, let's get to BTIG Managing Director and Restaurant Analyst Peter Saleh. Peter, it's good to see you here. Now, we said it was better than expected. It was still down 4% in terms of those comparable sales. So the turnaround efforts are sort of slowly and incrementally working. When do you think we see them inflect more positively?
Yeah, so thanks for having me on. Look, Starbucks top pick for us this year. We think you're going to start to see some of these results in the back half of fiscal 25 for them. Keep in mind, Brian got to Starbucks in September, so he's really had 3 months under his belt or so, changing the results. So, it's going to be slow. There's a lot of change going on. So I think you're going to start to see more momentum building in the comps and the margins and the earnings as we get into the back end of this year and then into fiscal 2026. So we're still very, very early innings of this turnaround story.
Peter, early innings, Brian Niccol, took the helm here in September, he laid out a vision, right? It's, let's focus on coffee and better pricing and faster service. In your opinion, early days, Peter, but is he hitting the right priorities?
So I think so. I think, they're focusing on throughput. That promise of 4-minute coffee. They're implementing the Siren system, which is going to increase their throughput pretty meaningfully. They're adding the coffee bars as well, which will also help alleviate some of the pressure on the baristas. Also keep in mind, as soon as Brian arrived in September, several weeks later, they started advertising for the first time in their history on TV during sporting events. They've never done that before. So they started that, I would say, maybe mid-October into November. That is new. That is something that he did at Chipotle and was wildly successful. I think you're going to see a lot more advertisements from Starbucks on TV during sporting events and other live events on TV, which I think is really going to be a sales driver once we start to pick up steam in the back half of this year.
Peter, it seems like a lot of the focus is on what is still yet to come. I'm curious, when you look at today's numbers, if there's anything specifically in there that is giving you some breadcrumbs, right, that are leading that direction, that are already turning.
Yeah, so look, I haven't had a chance to go through all the details quite yet, but I'm happy to see that the U.S. comp was a little bit better than expected. The traffic was still pretty weak. Would like to see that those results over in China also continue to get a little bit better. But I think more of the details are going to be on the earnings call. Again, the fundamentals right now, while modestly better, aren't the whole story. I think we're still early, but we want to hear about what the progress is on the promise of 4-minute coffee is, what their pricing plans are going to be going forward, what the ad strategy is. Keep in mind, he's made a lot of changes to the management team. And so I think he's got a strategic vision, and a lot of these things have yet to be implemented. And we've got some, several months or quarters ahead before we start to see some of the results of some of the things he's doing right now.
What about China specifically, Pete? I'm curious. I'm just looking at Q1. It looks like China comp sales down 6%, but that was better than what the analysts had penciled in. What do you see for that market, just now and ahead?
Yeah, I think, it's good to see if that's a little bit better and international is better. That buys them some time. I mean, they were looking at having some strategic partnership, potentially selling a piece of it. I think they should probably, in due time, we'll see how this works out. But if comps are improving, maybe you just want to hit pause on any major sale or any major decision and see how things progress in that market. So it encouraged to see it only down 6, although it is a still down 6 type number.
We got to know some robot chefs at Brian Niccol's from Chipotle. Chippy the robot, Autocado, I think, was one that was making guacamole. Now over at Starbucks, we have Siren, the robotic system, I guess you would call it. What are you expecting in terms of automation from Starbucks, and how much is that going to help with either the 4-minute coffee or some of the other throughput issues?
Yeah, look, I think the siren system is probably the most revolutionary system that they're going to be able to put into place. This was introduced to the investment community almost 2.5 years ago and was put on the back burner. It really helps cut the time to make frappuccinos in half. It alleviates a lot of the pressure on the baristas. Brian came in September and on his first earnings call at the end of October basically said, it's a full court press on this siren system. We're going to put it through to the stores and start with the stores that have the most constrained on throughput. So I think that's what you're going to see is this siren system start to be implemented across the system. Hopefully we'll get an update on the earnings call about how many of the restaurants already have it. But my sense is that we're still very early on in this process. It'll probably take them the better portion of this year, maybe even into next year, to get it into all the stores before we start to see the benefits of throughput.
Do you think that, a year from now, 5 years from now, Starbucks will have fewer people working in its stores, that its labor costs will be lower as a result of some of this automation?
Doubtful. I don't think so. I think you may be able to take out some time in terms of making some of the beverages, but again, that's only going to help increase your traffic and your transactions, which you're still going to need more baristas for. So doubtful. I think it'll help on throughput and same-store sales. I'm not counting it on it benefiting in terms of labor costs.
Gotcha. Peter, great to see you. Thank you so much for your perspective. I appreciate it.
Thank you.
So trending ticker we want to hit right now, Smithfield Foods. Now, why that might sound familiar to you, it's because it was public before, and that company making its public debut again on the Nasdaq today. The pork producer stock opening at about $21 a share here. And again, this was a company that used to be public. It was back in 2013 bought by a Hong Kong-based company that took it private, and now once again is coming public. It's actually the world's largest pork producer.
Yeah, brands we all know, like Nathan's Famous, of course.
Yes.
Broadly, kind of broader discussion about just the U.S. IPO market. We had plenty of guests, Julie, come on and try to scope out what that could look like in 2025. Some are optimistic, economy's growing, markets working, elections behind us.
Right.
We'll see.
We'll see if we get more of these. I don't know.
Time now for What to Watch Wednesday, January 29th, sponsored by Tasty Trade. Starting off on the earnings front, some heavy hitters in big tech reporting, including Microsoft, Meta, and Tesla. AI investment will be a big theme on earnings calls, with China's DeepSeek app and President Donald Trump's Stargate announcement sending shockwaves through the tech sector. Meta and Microsoft both anticipating big years in capital expenditures. They report after the closing bell. Meta announcing it expects to spend up to $65 billion. Microsoft said it would spend $80 billion for the year.
Sticking with Magnificent Seven, Tesla. It's also going to be reporting quarterly earnings after the close. Analysts expect a strong quarter from Tesla's energy business, and investors will be looking for any new details about the company's anticipated Model 2 vehicle.
But before all the big tech fireworks, of course, the Fed's interest rate decision that's coming in the afternoon. Federal Reserve Chair Jerome Powell will be giving a press conference after the decision. Yahoo Finance's coverage of the Fed decision will begin at 2 p.m. Eastern.
In this week's episode of the Yahoo Finance podcast, Decoding Retirement, host Robert Powell speaks with the founder and CEO of Icon Savings Plan, Lori Rowley, about how the modern workforce can find solutions to the retirement crisis. You can scan the QR code below to stay up to date with the latest episodes, and be sure to tune in to Decoding Retirement every Tuesday at 12 p.m. Eastern. Here's a look at today's episode.
Doug, it's now time for a segment that we call Retirement Reality, where we ask real people real retirement questions.
Sure.
Take a look.
You mentioned your husband sort of being the money master in the family. Do you have a desire? Like oftentimes women sort of delegate that to their husbands. Do you feel like you need to know about it, that it would be helpful to know, or are you happy to delegate it?
No, I like to know about it myself, and we talk a lot about it. He always lets me know the things that he's doing, like with our finances.
So, Doug, I know you spend a lot of time talking about helping households deal with money conversations, partnerships, I think you call them.
Yeah.
What do you think?
Yeah, so I think we should always be consulting our significant other around financial decisions. I think that's a good thing to do here. But what I strive for is creating fairness and equality inside households when it comes to finances and money. What I'd love to see is everyone, and she may be on the same page with her husband or not. I don't know enough here. But what we're striving for here is everyone knowing at a minimum where your assets are, knowing what income is being generated, having an idea of what the household expenses are, both having access to accounts, right? You should have the same apps on your phone. So the more we can create an equal playing field for households, the better off we're going to be. The great part about being a financial planner and putting forward financial plans for clients is that process does a very good job of getting everybody on the same page. So by getting kind of household participation around this, we really do increase the probability that you're going to hit your goals together. And we also do create that fairness and equality inside the household. And I think that's very important for relationships and marriages particularly. And I think it's actually wonderful for striving towards goals that you have together. This is a team game you're playing.
Team sport?
Absolutely.
Yeah. So what about like in cases where someone says, I want to do the day-to-day management of our household budget and the checking account and paying the bills.
Yeah.
And I'm going to manage the investments, but we're going to sort of meet on the weekends and maybe discuss what happened that week with our money.
Yeah, there's no right or wrong way as far as the division of labor goes when it comes to who's doing the day-to-day stuff in the household, right? I'm a financial advisor, or, I do this for a living. Why would my wife want to do the day-to-day? But it would be completely unacceptable for her not to know where the accounts are, where they're located, how to access them, what our net worth looks like, what spending looks like. My wife actually works with me, which is great. So she needs to even understand mechanics around the business, right? These are things that, again, create that equality. So if someone's doing the day-to-day, fantastic. What I do is meet with my wife on a quarterly basis. We go through net worth. We take a look at how we're doing. And we actually have a real conversation around what's going on behind those numbers, right? Numbers only tell you so much of the story. How about what our goals are? What did we do well this year?
Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. A bounce back day for the Nasdaq and the S&P as tech clawed back some of the losses it suffered Monday after China's DeepSeek AI model ignited a sell-off. The Dow also finished in positive territory. We'll dive into the rest of today's market trends. Then another turbulent quarter for Boeing comes to a close. We're going to recap the plane maker's latest earnings report and tell you if it's any closer to turning things around. Plus, as I just mentioned, China's DeepSeek is rattling markets and tech giants. So just how worried should these companies be? We're going to try to figure that out as well. Well, Boeing reporting fourth quarter earnings today. The company posted preliminary results, remember, last week, showing a wider loss than analysts expected. Shares were jumping nearly 8% after today's report, but those gains then tapered off to end the day. Joining us now for more is Ron Epstein, senior aerospace and defense analyst at BofA Securities. Ron, it's good to see you. So let's talk Boeing, Ron. Obviously, 2024, rough year. Looking ahead, though, to 2025, Ron, stock finished up about 1.5% today. As you look ahead, Ron, financial analyst, you know the company backwards and forwards. Are there reasons for optimism here, Ron, for investors?
Yeah, I think the quarter was an interesting quarter for a number of reasons. I mean, they pre-announced they took a big charge in defense, as you know. I think the conference call today was important. Management came out confident. The new CEO, Kelly Ortberg, this was his second call, and he came out and I think gave a broader assessment of the company. Is there reasons to be optimistic? Yeah, but a lot of it's second half loaded. So for example, the company didn't give financial guidance. They said it was too soon. The company told us all they know they're going to burn cash this year. We're modeling them to burn about $5 billion of cash. The first half of the year where you'll see most of the burn. Second half of the year should turn positive, but that's in the second half of the year. They're supposed to close a deal with Spirit AeroSystems. Remember, that's one of the supplier that used to be part of Boeing. They're bringing it back in. That probably happens in the second half of the year. They're trying to sell some assets to shore up the balance sheet. Maybe that happens before the second half of the year, but probably not. They talked about delivering like on 737s, maybe in the mid 400s, something like 38 airplanes per month. We keep track of what they're delivering. We keep track of what's coming off of their production lines, but we won't have a good idea of how things are really recovering from the strike until kind of the second half of the year. You've got a big air show in Paris, the Paris Air Show at Le Bourget. You'll probably see some order activity going into that show. That's a positive, but a lot of stuff is second half loaded. So are there reasons to be optimistic, cautiously optimistic? Yeah, I think so. In 2025, they should deliver more airplanes than 2024, all else being equal. They shouldn't have a strike this year. 2026 should be better than 2025. The 787 program seems to be doing okay. They're looking at delivering about 5 airplanes a month there. So kind of in short, to get back to your question, yeah, I think there's reasons to be cautiously optimistic, but as investors, we won't really see much tangible stuff until probably the second half of the year.
And is that why you're still neutral here, Ron? You just want to see more evidence?
Yeah, I mean, I think the stock is kind of range bound right now. We're neutral on the shares, as you mentioned, because of that. I'd like to see some kind of more proof of what's going on. And if you think broadly about Boeing, and I don't think management was coy about this on the call. They're going through a culture change at the company, and that's just going to take time. And they're pretty forthright about that. And I think you really have to start to see that cultural change at the company take root to really kind of know where Boeing's going to be in the future. One of the big questions that Boeing's going to have to answer at some point here, maybe this year, probably most definitely next year, are they going to do a new airplane? Airbus has been outselling them in the narrow-body market. The A320 family has outsold the 737, and it really kind of begs the question, when do they launch a new airplane, something that might replace the 737, something that might be a little bit bigger in the so-called middle of the market. But that's another question that they're going to have to answer. So I still think there's some things that have to happen to really be like a full-on bull on this thing. But the good news about everything kind of being in the second half of the year, there aren't targets that they really have to hit in the first half of the year. So, with not having any hard targets out there and having a big midsummer air show kind of coming up, Could you see the stock have a little lift to it? Yeah, sure. I would imagine it could.
What about the company's defense and space business, specifically, Ron? I'm curious, what do you see for that business now and ahead?
Yeah, so their defense and space business has had some major headwinds, and that was the source of the charges they took this quarter, right? Nearly $4 billion of charges, and the question there is that all behind you now? I mean, they were asked that on this call. They've been asked that on previous calls. To be fair to a previous leadership team, but the question always is, did you take all the charges? Is all this behind you? And what you invariably hear is, yes, we did. And then what you find out later is you didn't. These things tend to have a tail. I wouldn't be surprised in the future if you see some more charges in defense, and hopefully they get that behind them. We're looking for the recovery in defense to be kind of slow and steady. We're hopeful that the business can, the defense business can be maybe break even on a cash business on a cash level by 2026, but we'll see. And they've had fundamental challenges both in the defense business and in the commercial business.
A kind of broader question, you think about Boeing, but RTX, which I know you also cover, they reported as well today. Investors in these defense contractors, one question that keeps coming up, Ron, is actually Elon Musk and Doge and our new Department of Government Efficiency, and whether, Ron, that could actually lead to some cuts in U.S. military spending, what that would mean for some of these names. How as an analyst, are you trying to think through that?
Yeah, it's a great question. In our year ahead of piece, we address that. We're expecting defense spending to go up materially this year. If you look at some of the proposals that are floating around Congress, you could see $200 billion added to the defense budget over the next couple of years. So we actually think there's going to be upward pressure on defense. Now, when you look at the Doge activities, and we've written about this too, we're expecting it to be more focused on the civil side of government than the defense side of government. I think most of the contractors you talk to are welcome if there can be a more efficient way to do defense contracting. They would welcome it. You could get more volume through the business. But on a very, very fundamental level, what we're seeing is very, very strong demand for defense equipment, demand for submarines, demand for munitions, demand for tactical aircraft, and getting more of it quicker. So, if a Doge effort can make, that process more efficient, I think that's good for everybody involved. But I don't look at Doge as a problem for the defense budget per se in terms of magnitude of spend. We've even heard discussion of building an Iron Dome over the U.S. If that were to take place, that's very bullish for all the companies working on missiles. That would be a Raytheon, a Northrop, a Lockheed. You kind of go down the list. That's my take on it anyway.
Ron, great to have you on the show today. Thank you so much for your time and insight. Appreciate it.
Yeah, thank you.
U.S. stocks closing higher with the Nasdaq chipping away at the DeepSeek-fueled rout. Yahoo Finance's Jared Blickery joining us now with the trading day takeaways. Jared.
Don't call it a bounce, although that's what we got. And let's take a look at some of the reversal that we got today. And I'm calling it a dip. So I think it's fair to say that the dip was bought. And we're going to take a look at a few different things here. Let's go to the sector action first, and we'll see what was working today. Now, this is actually a two-day view, Josh. And you can see utilities and tech actually the worst off. Yesterday, tech was down 5%. And that was a huge reversal because today it was up. It was in the number one slot, up 2.5%. So that was the biggest reversal in tech that we've seen since the beginning of the bull market, basically, all the way back in November of 2022. I also want to show you what's happening. Let me just go back to the two-day and make another comment. So healthcare, staples, those are the two leading sectors, arguably a bit defensive there, but we're also seeing communication services, financials, consumer discretionary. This is all going to make a little bit more sense in about 2 to 3 minutes. So let me get to NVIDIA first, because I want to show you the two-day price action on there. You can see it's still down 9.6 over the last few days, but I want to show you the last month, because this is basically the all-time high right here. Here is the low that we had yesterday. The 200-day moving average is just a little bit above. So we fell into this key technical level, sliced through that, but then managed to climb above it today, close healthily above it. But as soon as we start getting into some of the price action from the prior consolidation area, and I'm going to highlight it right here, and this goes all the way up to about 140, we're going to see some resistance. So we're not at that resistance points just yet, but there's a lot to prove for NVIDIA because now we have the shorts excited.
You mentioned the reversal in tech. Any other reversals I should have on my radar I'm thinking about?
Yeah, I'm glad you mentioned it because we have Trump's reversal. So as you know, I've been tracking the Trump performance from the election to the inauguration and then since the inauguration. It's only been 6 days and we had about 80 in the prior period, so it's not perfectly apples to apples, but we are seeing some reversals here. This is 4 sectors. This is 4 out of the 11 large cap sectors that we have. And you can see consumer discretionary, we're getting some nice gains here. We got $845 billion in gains, and that was a big Amazon and Tesla story. That was into the inauguration. Since then, it's dwindled to $60 billion, but still in the positive direction. Financials, they clocked in over $600 billion in gains, and we had JP Morgan closing at record highs very recently. But then you take a look at tech. Tech was up $400 billion, 500 and change actually, and now it's down $600 billion. And so that's a huge loss just wiped out. I would note that investors actually bought that dip yesterday. They were investing money. When we look at flows, we saw huge flows into the Qs, which is very tech oriented. But then I would also point out healthcare. Healthcare has seen a big reversal. It was losing about $300 billion coming into the inauguration. Now it's up almost $300 billion. And who would have thought that healthcare would be this tremendous winner under Trump? And I'm not saying it's a perfect apples to apples comparison there, but that's kind of what I'm looking at.
How about, can I ask you this?
Yeah.
Bitcoin. Is that reversing too?
Let's take a look here because Bitcoin was actually up something like 50%, and I need my crypto screen there. It was up 50% between the election time and the inauguration, and now it's down 3%. So guess what? Bitcoin is kind of reversing too. However, this is what has happened basically it's going back to November of last year. All that is a consolidation. It's sideways, not meaning much technically, so I'm not too worried about Bitcoin right now.
All right, final Jared Blickery point.
We got to take a look at commodities. We haven't taken a look at commodities in a little bit. Specifically, I am looking at coffee futures percolate. I'm not even sure exactly what that means, but we're going to find out here on the Wi-Fi Interactive. Coffee futures are at a record high. Let me just show you what they've been doing recently. This is over the last 2 days. Let me just show you since the beginning of the year. I think they're going to be #1 as well, up 9%. By the way, 9% in futures is a huge amount because these are the inputs and these are heavily leveraged by people who trade them. So here is a 1-year chart of coffee futures and bam.
Wow, look at that move.
Look at that right there. And we just broke out. So you might think, well, there's some additional room to go there. I'll put a max chart, and this goes back to what, 2000, kind of the beginning of electronic trading. Far surpassing this high that we saw over the global financial crisis. A lot of people don't remember how expensive coffee got just before that happened, but crude oil did as well. And it's not limited to coffee. It's also some of the other softs. I can take a look, for instance, at sugar. That would be SB, and also cocoa. I'm not sure if we're going to be able to find this here, but you might have to take my word for it. SB equals F, sugar.
Right here.
Oh, can you punch that up for me?
I will.
Thank you, sir. All right, here we go. Now, this is a little bit of a different chart, and this is a max chart. So here's the global financial crisis. I want to take a look at the last year, and you can see that is not the same as the coffee chart, but we are off of these lows. This is the same low that we were hitting last August, and so I got to think that there's some room to run here for sugar futures. You combine this with the weaker dollar that we are now seeing.
That's why I was going to, with the dollar's reversing down.
If the dollar's reversing, that only makes coffee and sugar more expensive.
All right, there it is, Jared. Thank you, buddy.
You got it.
Appreciate it. Stick around, much more Ask for a Trend still to come. The arrival of China's DeepSeek AI model has called into question how much time and money it takes to create a competitive large language model, with investors looking to American companies like OpenAI and NVIDIA for answers. So how should retail traders approach the DeepSeek disruption? Joining us now is Tom Bruni, StockTwits Editor-in-Chief and VP of Community. Tom, always good to see you, have you here.
Thanks for having me, appreciate it.
So let's talk DeepSeek. Bold claims by the company and obviously caused some questions for investors, how they should be thinking about this mega AI trade. On StockTwits, what were people saying? What were they thinking? Were they optimistic? Were they skeptical? What were you hearing?
Yeah, this is certainly interesting timing with earnings season coming up. We've got 5 of the 7 Mag 7 reporting this week. So heading into this, we polled users on StockTwits. 6,800 people voted. Over 50% of them were looking for the Magnificent 7 to continue to dominate during earnings season. So looking for strong growth, optimistic outlooks. Heading into the DeepSeek risk, this is not something that was on anybody's radar, which is why we saw such a large reaction. So we did an additional poll yesterday during kind of all the carnage to see where people are, shifting their focus. And
when you saw that carnage, so there were some names getting really pummeled yesterday.
Yeah.
How were folks responding, reacting? What were they buying?
Yeah, I think generally people were looking to buy the secular leaders. Going back to the earnings season side of things, we're seeing a lot of activity around, the live earnings calls. People will be paying attention to management commentary and tuning in to see, how are these companies thinking about DeepSeek? Are they, super worried like investors are currently? Like, what does it mean for their total growth, market cap, overall market size? But overall, people are still optimistic about the overall AI trade. However, they're kind of picking their spots a bit more. So we saw infrastructure stocks kind of get hit. That's the semiconductor stocks, anything that's powering, these data centers like nuclear or any utility companies. And then we saw rotation into some of these software stocks that, are building applications on top of these LLMs. So their costs come down. And so people are viewing that as more of a rotation trade instead of saying, hey, I'm not investing in AI. They're just simply switching around where they're focused.
What about the face of AI, which was NVIDIA, which just got crushed yesterday?
Yeah.
When StockTwits folks saw that, what was the response, reaction? Were they moving in?
Yeah, so we generally saw people looking to buy the dip in NVIDIA. There's still a view that it is a secular long-term leader here. We did a poll, 17,000 active investors participated in it in under like 6 hours. And overwhelmingly, the response to our question, which was, what are you buying during this dip, was NVIDIA. 70% of respondents were picking that stock to stick with. And so they're sticking with the leaders, but they're being more selective around some of the other stocks that they're participating in.
If the framing is sort of like folks on StockTwits right now, Tom, feel generally optimistic, but also, as you noted, we've seen sort of a trend where, okay, optimistic, but getting more selective. Why is that?
Yeah, I think it comes down to risk management. Ultimately, these stocks, growth stocks trade a lot on momentum and technicals as much as they do fundamentals. And so there have been instances where a lot of popular stocks like AMD have spent a lot of time technically losing momentum. I believe AMD is down 30 or 40% from its highs. It's below a key kind of technical level that people use called the 200-day moving average. Basically, measures the long-term trend of a stock. And so, if prices are above it, generally things are in an uptrend. When prices are below it, generally in a downtrend. And so, stocks like AMD that have been stuck below that long-term average and losing momentum are not where people are buying the dips. Instead, they're looking to something like an NVIDIA that's right at its 200-day and being defended, or something like Broadcom, where it's still well above its 200-day, that long-term trend remains intact, and that's where people are looking to kind of add to their opportunities here.
All right, optimistic but selective. We'll leave it there. Tom, great to see you. Thanks
for having me.
Coming up, we are taking a deeper dive into the resiliency of corporate earnings. Stick around, we're asking for a trend right on the other side. our chart of the day, we are taking a closer look at forward earnings estimates for the S&P 500. And Yahoo Finance Julie Hyman joining me now with a closer look. Julie.
Hey, this one is another chart book special. Remember, Yahoo Finance today came out with dozens of charts that'll help you get set up for the beginning of 2025 and through the year. This one coming to us from Keith Lerner of Truist. And he basically said this has really been what he called the key pillar of the stock market rally, the fact that earnings do keep growing. So we're looking here at forward earnings estimates in white versus the S&P 500 in blue. That has meant margin expansion, price to earnings has gone higher, but it has been underpinned by actual earnings growth. He said the sustainability of the rally is really going to depend this year on whether this growth continued. And this is something that we asked Allspring's Margie Patel about at the top of the show, whether indeed it is going to continue. She said yes.
Yes, I think it's going to be a surprisingly good year, still modest returns. Last year, we did get a big boost from price earnings ratios going up. I think this year, returns will really be more just from profit growth. And the issue is that many sectors of the market really have possibly earnings declines or very modest growth. If we have, say, a GDP that's 2.5%, S&P revenue is up 4%, I think that says we should conservatively have profit growth of 10%.
And this has really been a common refrain of strategists that we've been speaking to recently, Josh, as you know, the fact that they are expecting profit growth to continue, and that would be enough to continue to propel stocks higher, even if we're not going to match the same size of returns that we've seen the past couple of years.
You know, it's interesting when we also asked Margie what worried her, you know, what's on her radar. Not much, really, she said. Pretty broadly constructive, Julie.
She's not the only one. There's a lot of folks who are pretty bullish out there right now.
Julie, thank you. Appreciate it. And that is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.